Good evening. Welcome to STC's educational webinar entitled Advanced Insights for Self-Directed Retirement Accounts. I'm Jackie Knight. I'm very glad to have you join me this evening. We will have a Q&A session at the end of the webinar. Please type your questions into the question box on your screen, and in the meantime, we'll go ahead and get started. Now, as I begin giving you information, I do need to tell you a little bit about STC. STC is a retirement plan administrator only, so we do not provide legal, tax, or investment advice. We also don't represent or sell securities or any investments of any kind. We're not a registered investment advisor, and we don't endorse or represent any particular investment opportunities. If I talk about some in this webinar, it's just to give you an idea of things that you could do with your self-directed account, but we don't represent or endorse any investments. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. Now, this evening's webinar is going to cover some basic information about self-directed retirement accounts, and then I'm going to give you some specifics about particular types of accounts. We're going to talk about Roth conversions, non-recourse loans. We're going to talk about a tax that can be levied on a retirement account in rare instances, UBIT and UDFI. We're going to talk about the retirement account LLC structure that STC sets up for each client and the services that we offer. And then I'll open the floor for your questions and I will answer those. So to get started, I do want to start with a definition of what is a self-directed retirement plan. It means that you have your plan with an administrator or custodial company that permits you to choose any type of asset that is allowed by law in your retirement account. So that would mean you could include non-traditional assets like real estate. We have many clients come to us who are interested in real estate types of transactions, and they certainly are permitted in your retirement account. Self-direction also means that you manage your retirement plan's assets. So you will make the decisions relative to your investments. If you owned a rental property, you would decide the rental rate. You would decide if you wanted to renovate the property, if you wanted to put a new refrigerator in it. You would make the decisions related to the assets held in your account. So this really means that you have control. You get to make the decisions that affect the assets that you own. You choose the assets that you want to own. And so you have more control than you would have in just buying a stock or a mutual fund. Now, why would you want to self-direct? Well, most people do it partially so that they can diversify their asset types. Rather than just holding stocks, bonds, and mutual funds, they want to be able to include things like real estate, mortgages, and notes. You can actually lend money from your retirement account. You can invest in a private business. Again, that control is another reason some people want to self-direct their retirement accounts. And as it relates to real estate purchases, you do also have the ability to use leverage in your retirement account when it's self-directed. So that might be something that would be of interest, especially to real estate investors. And we will talk a little bit more about the kind of leverage that you can use in a self-directed retirement account. Before I get to that, I do want to talk just briefly about different types of retirement plans, and any of these types can be self-directed. So a self-directed plan isn't a type of plan, rather it means that you're holding with a company that permits self-direction. So some plans that you may have heard of, traditional IRA, Roth IRA, these are similar in that they have identical annual contribution limits. In 2016, you can contribute a maximum of $5,500 of your earned income into either of these plans. If you're 50 years or older, you can contribute $6,500. A significant difference between these two types of plans is that a traditional IRA, like the majority of retirement accounts, contributions made into these accounts are not taxed. you begin paying taxes when you take qualified distributions after reaching retirement age. With a Roth account, it's different. Your Roth contributions are taxed in the year you make them into the account. However, not only are Roth fund monies that are earned tax deferred, they're actually tax-free if you wait until you reach retirement age and begin taking qualified distributions, because distributions from a Roth account are not taxed. So that is a significant difference between a Roth account and other types of retirement accounts. A SEP is a simplified employee pension plan, and a SIMPLE is a savings incentive match plan. These types of plans are all often used by sole proprietors or small business owners. They do permit larger contribution amounts. You can have employee and employer contributions, so they might be of interest to those of you that might be self-employed or have small businesses. I'm bringing out onto your screen now 4 different types of plans that all say former employer. If you formerly worked with an employer and participated in any of these plans, a 401k, that's a corporate for-profit type of company plan, 403b, that's often charitable organizations or nonprofits might have 403bs, TSAs are tax-sheltered annuities, TSPs are thrift savings plans. If you formerly participated in one of these types of plans and no longer work with that employer, you are permitted to roll those monies out of those plans, and you can put them into a traditional IRA, or if you have your own business, you can move it into a SEP, any plan that you qualify for, and then those monies could be self-directed if you wished. And then, of course, a regular 401k plan. If you are a business owner, you may have a 401k plan for your company. These can be self-directed. If you currently are employed and are participating in a 401k plan, you will need to go to your plan administrator to determine if you are able to move any monies out of that plan to a self-directed plan with another company, exactly what their rules permit. Each corporate plan has its own rules, so you would need to go to your employer for that kind of information. If you currently don't have a retirement plan and you'd like to open, say, a traditional or a Roth, you will need to do that before December 31st of this year in order to be able to make a contribution from your earnings this year. Now, the contribution can be made up until the time you file your tax return next year, so you don't have to put the money into the account, but you do have to have the account open. So just a little bit about different types of retirement plans. Now, I have talked to many folks who have worked at multiple organizations and participated in 401k plans or a variety of different types of plans at these different organizations. So sometimes they have little pots of money in different plans. One of the things that you can do is you can roll monies over and consolidate them into a single account that you qualify for, or maybe 2 different kinds of accounts depending on what you want to do. So, for example, you can move money from an IRA into a SEP or from a SEP into an IRA. So let's say, for example, you have a business and you have a SEP and you've been making contributions, and now you're ready to retire. You're going to close up that SEP. You can move that money into an IRA account, and then maybe your earnings would be significantly reduced, so then you can continue making contributions into the IRA account from your earned income. So you can, there is portability between certain types of accounts. Generally, they need to be like kinds of accounts with an exception. And you'll see I brought out onto your screen IRA, SEP, SIMPLE, any of those monies from any of those accounts going into a Roth account. Now, you can do that, but you must be aware that when you do that, there will be a tax consequence. Because contributions to Roth accounts are taxed, I mentioned that earlier, and to IRAs and SEPs and SIMPLEs, they are not. When you're moving that money into a Roth account, it will be included in your taxable income. We're going to talk a little bit more about that, but I just want you to be aware that you can do that, but there will be a tax consequence in the year that you do that. Just a little bit about contribution limits and RMD. RMD stands for Required Minimum Distribution. And in some accounts, in the year that you reach age 70 and a half, you must begin taking minimum distributions from that account. Now, with a traditional and a Roth account, I already mentioned the annual contribution limits were $5,500 and $6,500. A traditional account does have an RMD. A Roth account does not. With Roth accounts, you are not required to take a minimum distribution when you reach age 70 and a half. SEP accounts, the maximum annual contribution into a SEP is $53,000 in 2016. And if your company is incorporated, then that is 25% of W-2 income up to a maximum of $53,000. If you aren't incorporated, if you operate as a sole proprietor or self-employed, then 20% of your self-employed income up to a maximum of $53,000. With a SEP plan, there is an RMD. There is a required minimum distribution. A few more account specifics. There are penalties that can be levied against your retirement account if you take early distributions. Early distributions would be payments that you receive before age 59 and a half. Usually, those payments are subject to an additional 10% tax. So, for example, let's say you took an early distribution from your traditional IRA. The amount of that distribution would be included in your taxable income for that year. So you'd be paying your regular tax rate on it, plus an additional 10% penalty for that early withdrawal. Early distributions must be reported to the IRS, and it is, but something about a Roth account, if you take an early distribution from a Roth account, the portion of that distribution that is attributable to contributions is not taxed. So there will be an accounting done in your Roth account, what your contributions were versus what the account has earned, and your tax accountant will help you determine what portion must be, taxes must be paid on. So just a few things to keep in mind if you do determine that you need to take funds from your retirement account prior to reaching 59 and a half. There will be some tax consequences of doing that. Now, I mentioned Roth accounts earlier, and I said that contributions to Roth accounts are not pre-tax. They're actually post-tax. They're not deducted from your taxable income. However, there are some advantages, and that is that when you take qualified distributions after reaching 59 and a half, there are no taxes on those distributions. In addition, there's no required minimum distribution when you reach age 70 and a half. Now, there are some income limitations. Modified adjusted gross income must be less than a certain dollar amount for a full contribution. You will want to check with your tax preparer to determine how that might apply to you. However, you can convert from other types of accounts to a Roth account, and the income limitation for conversions has been eliminated. So you can make contributions to a traditional account and then convert it to a Roth account, paying those taxes. So there is a way to get around that income limitation if you're interested in doing that. Now, very important to keep in mind, if you are going to do a conversion, if you're going to convert monies from a traditional or other type of account into a Roth account, there will be taxes due and payable. And the taxes, if they're paid from the converted account, may be considered an early distribution, which would then be penalized. So you will want to determine how you're going to handle the taxes with your tax accountant. You can convert from multiple accounts. So let's say you have multiple, maybe you have an IRA, traditional IRA, and a SEP account, and you're going to convert the traditional IRA and SEP. You can put those into the same Roth account, so you can do from multiple accounts, and you can also do partial accounts. So you don't have to convert all of the funds in an account. You can do part of them. And many people might do that, over a several-year period because of the tax consequences, so that they can spread those taxes out over several years. So this would be something that you would definitely want to check with your accountant. If you're interested in having a Roth account and don't have one now, or you're interested in getting more funds into a Roth account, it certainly can benefit you in the long run with that tax-free growth opportunity, but you do want to make sure you understand the tax consequences and how best to do that for your particular circumstances and situation. Now, a topic that is often of a lot of interest to real estate investors, and I know that I have a number of real estate folks on the webinar tonight, is non-recourse loans and how that works. So with a self-directed retirement account, you can leverage a real estate purchase. However, you must use a non-recourse loan. Your retirement account must use a non-recourse loan. And that is because your retirement account is not a person. It doesn't have a job. There's no income verification. There's no personal guarantee. You can't personally guarantee a loan for your retirement account. That actually violates one of the IRS prohibited transaction rules. So you cannot personally guarantee a loan for your retirement account. So your retirement account stands on its own, and your retirement account would be getting this loan. So it must be a non-recourse loan. So what is a non-recourse loan? It simply means that the security instruments, the notes, the mortgages, allow no recourse against the individual account holder, against you, the account owner, or the balance in your retirement account. So if there is a default or a foreclosure, the property itself is the only recourse for the repayment for the borrower. It's the only recourse the borrower has. So kind of bottom line, a non-recourse loan is going to be similar to a commercial loan as opposed to a personal loan. With a non-recourse loan, there's no income or employment verification because, again, your retirement account doesn't have a job, doesn't have an employment history. I'm going to go through some kind of industry standards, but what you want to do if you're interested in getting a non-recourse loan for a retirement account purchase, you're going to want to go online or go to your sources, your lending sources, and ask what their particular requirements are for a non-recourse loan. What I'm going to tell you now are just some general industry guidelines that generally most non-recourse lenders would do. So required documentation. You're going to, of course, need to fill out a loan application. They're going to want to see a purchase and a sales contract. They will definitely want to see a statement of your IRA or your SEP or whatever the account type you have. They're going to want to see what assets are held, what the balance is. They'll probably want to see how much is in cash, how much is in other types of assets. They will likely want an appraisal of the property that you are interested in purchasing. And if it's a rental property, they will want to see a rent roll. Loan guidelines, generally, the maximum loan to value would be 70%. In other words, you're going to have to put down a minimum of 30%. Maximum term on these loans, really anywhere from 20 to 30 years. We have seen some non-recourse lenders do adjustable rate mortgages, 3-1, 5-1, 7-1. So again, that's just something you would determine when you go out and do your research looking for lenders. Oftentimes they will look at properties with an income to expense ratio of at least 1.25. So they're going to want to see income over expenses 1.25 times. And usually they will require you to hold a certain dollar amount of reserves in your account. Usually it's anywhere from 3 to 6 months of expenses. So you will need to have some cash reserve in your account. It's very likely that you will. Eligible properties for non-recourse loans, single-family residences, some condos, again you'd have to check with the lender specifically, duplexes up to 4-plex properties, multifamily properties, 5 or more units, and retail, office, and warehouse. So you will find some folks who might be doing a real estate syndication purchase for commercial property, and they'll be getting a non-recourse loan for that, and then retirement accounts can participate in that syndication. So that's something that, if that's of interest to you, you could look into too. Ineligible properties for non-recourse loans, mobile homes, timeshares, condo hotels, some restaurants, residences that have 5 or more acres, and farms. Usually non-recourse loans are not available for those types of properties. So I am going to give you, well, I'll just carry on with this. So non-recourse loans can certainly be valuable in financing a property in your retirement account. If you don't have sufficient funds but you feel that it's a good investment, you may want to check into getting a non-recourse loan to make the purchase. Now, I want to talk a little bit about the tax that can come into play in a retirement account. There is something called unrelated business taxable income, UBIT, or it's also called UBIT, unrelated business income tax. That's actually the tax on that income. And UBIT was designed by the IRS so that charitable organizations wouldn't have a benefit over for-profit organizations if they had an income-producing part of the business that wasn't tied to their tax-exempt status. For example, that kind of might not be real clear. So let me just give you an example. Let's say a university that is a public university, nonprofit, has a stadium and they rent that out for concerts. That university is not in the business of putting on concerts. That is something that is aside from their primary charitable purpose, their nonprofit purpose, and so those revenues would be taxed to that organization. So the IRS has decided that retirement accounts fall into that same category. Now, in most cases, IRA investments generate passive income, and so they would be exempt from UBIT. Passive income would be things like interest income, rental income, dividends, distributions. And the sale of real estate and the gain on a sale of a piece of property would also be considered passive as long as the intention of that purpose was for appreciation and then selling and a long-term gain. There are rare exceptions where the IRS might consider an investor an active participant, and then the income would be taxable. But real estate investments, generally you're purchasing them, then you're selling them down, maybe you're holding them as a rental property and then you sell them a few years later. So you were holding that for appreciation. So generally that should not be taxable. It should be considered passive. Now there is a subset of UBIT called UDFI, unrelated debt financed income. This applies to income generated from an asset that was purchased using financing. Okay, so go back to when I was talking about non-recourse loans. Let's say your retirement account got a non-recourse loan to purchase a property that you rent out. So that rental income is coming into your retirement account, and because that is debt financed, that the purchase of that property was debt financed, some of that income is going to be taxable. Now, UDFI is based on the net income of the property. So that means you're going to be able to deduct all of the expenses related to that property from the income. So, and then what you have left over, that would be what the tax was based on. The first $1,000 of net income is exempt from the tax. So no tax on the first $1,000. Then after that, only the percentage of taxable income, is based on the ratio of debt on the property. So if you financed 30% of the purchase price, then only 30% of that net income is subject to this tax. 40% with debt finance, 40% of the net income is subject to the tax. Now, when the asset is sold, if there is any debt outstanding on that property in the previous 12 months prior to sale, then there will also be UDFI on the gain of that sale. So let me just make a couple of comments about this. It can be a little complicated, and of course you would want to talk to your accountant about it. But when we're talking about the taxable income, the percentage that is taxed each year, and that's based on the ratio of the debt. The first year, you'll pay, let's say it was 40% debt finance. Then you would pay, on 40% of the income, you would pay tax. The next year, you've been paying down that loan, and let's just say you got it paid down, so now only 30% of it is debt finance. You paid off 10% of that loan, or forget, you paid off part of the loan. Now only 30% of the income is taxable. So as you pay down the loan, it reduces the portion of the net income that's taxable. When you sell the asset, the portion of the gain is no longer based on the debt to the sales price, the purchase price. Now it's the debt to the sales price. So let's say you sold that property for a much higher number and your percentage is 30%, then it would be a smaller percent of the gain that would be taxable. Let me show you an example to help you understand it. This will be an example of how the net income, the annual net income from your property would work. Let's say you have an example investment. It's a rental property, and it's 50% debt finance. Just for ease of, we'll say it's a $200,000 property. You put down $100,000 and you financed $100,000. So it's a 50% debt finance property. The annual net rental income is $12,000. Your renters pay $1,000 a month. Or no, they pay more than that. This is net. So all the expenses have been deducted, and you earn $12,000 of net rental income. The amount that is subject to UDFI will be $5,000. Remember, I said that this property is 50% debt finance. So that means only 50% of your $12,000 is subject to UDFI. So that would be $6,000. And also remember that I told you the first $1,000 was tax exempt. So $6,000 minus $1,000 leaves you with $5,000 that is subject to UDFI. Now, this is taxed at the trust tax rate, and I picked the high end of 39%. You would want to check with your accountant to see what it was, what applied to you. But I went the high route. So the taxes on this particular property, this example, would be $1,950. That's 39% of $5,000. Your net income after UDFI on this property is $10,050. So that's $12,000 minus $1,950. So $10,050. So what I want you to think about is, you know, I have sometimes people talk to me and they go, well, I don't want to take out a loan because I don't want to have to pay taxes. But if taking out the loan is the only way to purchase the property and have that source of earning, I mean, you want to work through the calculation. It might be worth it to pay taxes if you're going to have net income after taxes sufficient to make that a good investment. So you do want to think about how that would play out in your account. Talk to your tax accountant. Have them run the numbers for you. It might well be worth it to go in search of a non-recourse loan. Now, UBIT and UDFI are reported to the IRS on Tax Form 990T. The taxes, UBIT and UDFI, must be paid from the retirement account. You cannot pay them personally because it is a debt of the retirement account. Taxable as a trust rate, tax, and do discuss with your tax advisor. They can help you go through those details. Now I want to take just a couple of minutes and talk about the structure that STC uses for each of our clients' accounts and why we use it. What we do is we actually set up an LLC for each client's account. And this is a very specific type of LLC. It is its articles of organization and its operating agreement are written specifically to comply with the laws that relate to retirement accounts. So it is designed to be owned by a retirement account. And we do this because there are a number of benefits of using this type of structure in self-directed investing. First, it gives you maximum flexibility in structuring transactions. And I'm going to tell you on the next couple of slides that you can actually partner funds from your retirement account with other sources of funds to co-own an investment. And so using an LLC structure can help facilitate that. It also can help facilitate getting a non-recourse loan. If a loan is involved, the LLC structure gives you a lot of flexibility in structuring complex transactions. It does also provide an additional layer of asset protection because it is a limited liability company. It also gives you checkbook control over your retirement funds so that you have immediate response to an investment opportunity. Now, we know that good investments can come and go very quickly, and you need to be able to move on them. That's what our LLC structure helps you accomplish. Now, you'll notice that I have checkbook control in quotes, and that is by design. We do not give our clients the checkbook for their retirement account. You may be able to find a company that will do that. We do not. And we do that purposefully because we don't want to put our clients in a precarious position of potentially engaging in a prohibited transaction. If you don't know the IRS rules related to retirement accounts, you might unknowingly engage in a prohibited transaction, and the penalties for doing that can be very severe, up to even forfeiting your retirement account. So rather than do that, what we do is for each client, when they have a transaction, they send the documentation to us via fax or scan documents via email. We review that immediately, and we can same day fund that transaction if we have those documents by 2 p.m. Eastern Time. If not that day, next business day. So what you have is you have our experts looking over your transaction, asking any questions, making sure that you're not going to engage in a prohibited transaction before you do it. So I call it protected checkbook control. You've got the protection of our experts, but you've still got that immediate response to an investment opportunity. This structure also simplifies asset titling. When, let's say, for example, you want to purchase a piece of real estate in your retirement account, you don't have to send those closing documents to our office and wait for somebody at our office to sign them and send them back. Rather, you can go to the closing of the property and you can sign those documents on behalf of your retirement account because you are the co-manager of this LLC. So it simplifies asset titling for your retirement account investments. And it also makes it easy, simplifies pooling or partnering with other funding sources. So let's just talk a little bit about partnering with others. Now, if you have listened to any of my other webinars, you may have heard me go through some prohibited transactions. And some prohibited transactions, by the IRS's definitions, involve disqualified persons. There are some people or entities that are disqualified from doing a direct transaction with your retirement account. And some of those people are you personally, your spouse, certain family members like your parents and your children, and any entities that you own a majority ownership of. Those are disqualified persons to your retirement account. However, in certain situations, your retirement account can partner with your own personal money or your spouse's retirement account or family members like parents and children, and other people, investing colleagues, LLCs, investment syndications. You can partner with these other funding sources to co-own an investment. And as long as this partnership happens at the inception of the transaction, you can even include otherwise disqualified parties like yourself, like your spouse, like your father, like your daughter. As long as the partnership happens at the inception of the transaction, you can partner. I'm going to show you a little schematic of that on the next slide. I do also, though, here want to mention that your retirement account can also be a source of funding for somebody else's investment. In other words, you're making a loan to them. We have a number of clients who do that type of thing too. So you would actually be lending money to somebody in that case as opposed to co-owning with them. Let me just show you a little schematic here, give you kind of an overview of how the setup works. You'll see here on the upper left the current custodian where you currently hold your account. You decide that you're going to work with SEC and you want to move some money to us. So you would complete documents that we would execute that would direct your current custodian to transfer or roll over money to our self-directed custodian. While that is happening, we would be working to set up an LLC in the state of your choice. Once the money has reached our custodian and your LLC setup is complete, then another document is executed that directs our custodian to purchase all of the ownership of this LLC with all of the funds in your account. So now your retirement money moves to a bank account that your LLC has access to, and the ownership of the LLC moves to the custodian. And now you're ready to invest. And in this schematic, you'll see that your retirement account wholly owns or is the sole owner of investment 1 and investment 2. However, investment 3 has 4 owners: your retirement account, your father, your daughter, and some of your personal money. So that does work as long as, normally these 3 parties would be disqualified persons, but as long as you co-invest at the inception of the purchase transaction, then this is permissible. So we do have lots of folks who come to us who want to do this type of a transaction, maybe with personal money or their spouse's retirement account or some family member. So it can be done, and we would love to help you do that. We will, our client services department will talk with you and walk through how the paperwork needs to be titled in order to make sure that that is a viable, permissible transaction. Okay, now I'm going to take just a couple of minutes to tell you about SEC and our full service approach, because that's what we are. We are a full service self-directed retirement account administrator. So we do this setup of your IRA, your retirement account LLC structure. Each account has an LLC. We offer you that protected checkbook control that I described. We have CPAs and attorneys available to answer your technical questions. We offer unlimited guidance on transaction compliance. You can call our office as much as you need to, email, talk with our client services department. They will help you understand, help you structure your transaction so that it complies with the IRS guidelines. As much help as you need, we're willing to give you. We handle all of the back office support. There are reports that need to be made to the IRS. All of your transactions need to be recorded and maintained. We'll maintain financial statements for your LLC. We will supervise the regulatory reporting that is required for all retirement accounts, and we will oversee the annual valuation and the reporting to the IRS. So we really want to provide all of the back office support for your retirement account, so that really all you need to focus on is the transactions, finding the investments that are the best for your retirement account. Now, just quickly, I want to ask, how can we serve you? Maybe you want to open a self-directed account. Maybe you have clients or colleagues that might be interested in self-direction, or maybe you simply need more information. Please get in touch with us. You can contact me. My email address is jknight@stcira.com. You can find that on our website at stcira.com, and our corporate number is listed. So please do get in touch with you. Whatever kind of information or assistance you need, we are happy to give that. Now I am going to open the floor for questions. I have about 10 minutes. So please do, if you haven't yet, type your questions into the little question box. Again, for those of you who may have joined late, you should have a question bar on your task pane somewhere. You click the little plus sign next to that, and you can type in that box, and then I can read that. So if you'll give me just a moment to open up the question box so I can see your questions. And I did get a couple in advance of the webinar, so let me look at those while first to make sure I cover those. Okay, the first one. Is the mandatory IRA distribution, and I'm assuming the person means required minimum distribution, mandatory, this is mandatory minimum distribution based on total assets or cash on hand or equity? Okay, so the required minimum distribution, once you reach the year that you reach age 70 and a half, you are required to take that from accounts except for the Roth account. It is based on the value of your account the prior December 31st, and it's calculated by dividing that balance based on a life expectancy factor, and the IRS publishes that. So the question here is, what is that value that it's based on? And it would be the value that is reported to the IRS. And the custodian will calculate that value. So for example, if you owned a piece of real estate, the price that you paid for that real estate until it had an appraisal done, if you ever had to take an appraisal, which you likely would have to do in the year that you're reaching 70 and a half, that property would be appraised. Now that appraisal value is part of your retirement account, plus any cash, plus the value of other investments. All of that would equal the value of your account at year end. And then your tax accountant would go to the IRS rules and find that factor that would be based on your life expectancy, and they would calculate the required minimum distribution. So that is how it's based on the value of your account. And if you own property, self-directed company, we would require an appraisal in order to properly calculate that RMD. Okay, and let me know if that didn't completely answer your question. I can see if I can elaborate. Okay, this person would like information on partnering to buy rental real estate. Well, I did talk a bit about how you can partner with other funding sources. Now, we can't direct you to other funding sources. We're not permitted to do that, but you can, talk to your investing colleagues, perhaps attend a RIA meeting, Real Estate Investment Association meetings. There are a number of those where I live, probably where you live too. You may be able to find some investments simply by doing some searching online and then doing due diligence into those investors. You can partner again with the folks, even otherwise disqualified persons, as long as you follow that co-investing at the inception of the transaction rule. Okay, I hope that answered that question. If not, you can define a little more for me. Okay, this person is interested in finding sources for non-recourse loans to purchase Maryland real estate. We're not actually permitted to recommend any lenders. What we would suggest you do, we did do a joint webinar with a lender that you could go to and talk with about what you're looking for, and you can find that joint webinar on our website. I would just probably start with talking with your contacts, talking with lenders that you currently know, seeing if they do non-recourse loans and what their terms would be, and then doing a Google search and researching various non-recourse lenders, of course doing your due diligence to determine their viability and understand how they operate. By the way, someone is looking for an institution that's closer to home. Just for everyone's benefit, I will let you know that we are headquartered in Hagerstown, Maryland. You are welcome to visit our offices if you are ever in the area. So that is where we are headquartered. We do operate throughout the United States, so we can open accounts anywhere in the United States, but that is where our headquarters are. Okay, let me look at some of these next questions. I have money that is time to time idle for long but indefinite periods. I would like to earn a return by buying short-term instruments that will earn more than the low bank interest rate. Yep. Earn more, but money is available. Well, what I can tell you is you would need to look into some short-term investments. See if you can get some kind of a money market instrument in your retirement account. You certainly can open a brokerage account in your self-directed retirement account that you could trade. We have folks do that, and then of course you would be the one deciding, okay, now I found another investment, so I'm going to liquidate these stocks or a portion of my mutual funds, and then you have liquidity there. So you can open a brokerage account in your self-directed account. Let me see if I understand this question. This person is interested in investing in seed startup investing. Would like to do it within their self-directed Roth IRA. As long as the investment does not violate any of the prohibited transaction rules, there shouldn't be a problem with that. Some of those rules might include things like you can't work for the business that your IRA is investing in. Your IRA can't invest in a business that your spouse or your parents or your ascendants or descendants are involved in. So you would need to look at those rules and make sure that the investment wouldn't violate any of those. But other than that, I don't know why. I think that would be fine. Okay. Can I open an IRA account if I'm over 60, and what is the minimum initial deposit? Yes, you can. If you meet the following criteria, and this is based on IRS publication 590, if you received taxable compensation during the year and you were not 70.5 by the end of the year. Once you reach 70.5, then you are no longer permitted to contribute. The amount to open an account, if this is a new account, would be $250. Of course, you can move money from a current account into an account with us, and that could take care of that minimum. What is the time frame to get my account set up and running with FTC? Typically, we do ask for 4 to 6 weeks from the time that we receive the original paperwork at our corporate office to have the account set up completed. During that time frame, we will coordinate the transfer of your retirement assets from your current custodian to our custodian. We'll also create that LLC I told you about. We do keep you informed of during the process where we are in the process. Once the funding of your new account is complete, we do send you a confirmation email, and then you also receive a binder in the mail that will give you all the account documents and instructions for making future contributions and to fund transactions. And then once that account setup is complete, then you have that same day or next day funding of your investments. So it is just the initial time frame to get the funds moved from your custodian to our custodian and the LLC set up, and then the funds move to that bank account. It can happen a lot more quickly than that, but we do ask that if you are already looking for investments, please don't wait until you find an investment to send in your paperwork, because it does take a little bit of time to get set up initially. I want to start investing in real estate, but I don't have enough in my IRA to buy a property outright. Do I have any other options? Yes, of course, you could use a non-recourse loan that we talked about in detail. And you could also partner with other people. Of course, your retirement account wouldn't own it solely, but you could have a portion of that investment. So those are really the two ways you could participate. I should mention that a lot of people with smaller accounts often, and who are interested in real estate investing, oftentimes will look into tax lien investing. Tax liens can offer very high interest rates. If the tax lien is not paid back, it is a foreclosable lien, so you could actually foreclose on that lien and own the property in your retirement account. So that is a possibility for you too, to consider tax lien investing. If I have a rental property in my account, who does the renter send their rent check to? And the answer to that will really depend on if you're using a property manager or not. We do highly recommend that you use a property manager so that you maintain an arm's length between you personally and the investment in your retirement account. Typically, when the property manager collects the rent, the checks are made payable to them, and then they forward any excess funds over expenses of the property to your IRA LLC, and they'll send us the check. If you're not using a property manager, then the checks would be made payable to your IRA LLC and mailed to our office, or to you. If they're mailed to you, then you have to mail them to us. In either way, we once we receive those and deposit and post them to your account, we'll send you an email, so you would know those funds are in your account. Okay, just a couple more questions. Okay, a traditional IRA requires the owner to begin withdrawals at age 70 and a half. If one owns real estate in their account, is it required to sell it at some point in time? And if income from the property exceeds the allowable contribution, how is that handled? Okay, these are two separate questions. So first, I'll answer the first one. If you own a piece of real estate in your retirement account and you reach the age that you must begin taking required minimum distributions, you don't actually have to sell the property. There are a couple of ways you could handle this. The required minimum distribution will be calculated based on the December 31st of the prior year's value of all of your accounts, and using that factor that the IRS publishes. Now, if you have multiple accounts, all of those accounts' value will be added together, and then the calculation is done. And you can take that required minimum distribution from any of the accounts. So it doesn't have to be a pro rata portion from all the accounts. So you might have cash in one account and a property in another account. You could take it from the account with cash. Let's say, though, you've just got one account and it has a property in it and very little cash, and you're required to take that minimum distribution. You could sell the property, but you're not required to. If you sold the property, then you would have the cash to pay. Let's say you don't want to sell the property. So what you could do is you could have that property appraised, and then you could distribute a portion of the ownership of that property to yourself as the required minimum distribution. And what that would mean is then that property would now be retitled in your retirement account's name and your name based on the percentages of ownership. And you could do it that way. So you don't have to sell the property. Now, the second part of this question, and I'm running out of time, so let me just answer this and then we will close. If income from the property exceeds the allowable contribution, how is that handled? Let me say that those are two different things. Income from an investment and contributions are two separate things. Your investments can earn as much as they can earn, and that's good. You want them to earn as much as they can earn. Your contributions, your annual contributions, those come from your earned income, and those are limited based on the type of accounts you have. So it's only your contributions that are limited, not the earnings on your investments. Folks, I hope that I was able to answer your questions and give you some good information tonight. We do educational webinars every month, and next month's webinar will be the first Thursday of November. I believe that is November, I believe it's November 3rd. So please do, if you didn't get, if you got an invitation to this webinar, you will get an invitation to that one. And you can also always register from our website. Thank you so much for joining me tonight. If you do need any assistance, if you're interested in opening an account or have any more questions, please do give me a call or contact me directly. My contact information is on our website. We would love to help you get the information you or your colleagues need to consider self-directing for yourself. Thank you so much. Good night.